What to avoid when investing in real estate in Asia. Investing in real estate in Asia can be rewarding, but the region's complexity means you need to be smart and careful. Each country comes with different rules, risks, and market dynamics. Here's what to avoid to stay out of trouble and protect your investment. 1. Ignoring local laws and restrictions. Many Asian countries have strict laws around foreign ownership. In places like Thailand, foreigners can't own land directly, only condos under certain conditions. In Indonesia, land titles like hak milik, freehold, are reserved for citizens. If you buy property without understanding ownership rights, you could end up with no legal claim. Avoid relying on hearsay or agents who know a way around the law. Always get local legal advice and read the fine print. 2. Assuming all markets move the same way. Asia isn't one market, it's dozens of very different ones. A boom in Vietnam doesn't mean Malaysia or Japan is also booming. Economic growth, demographics, political stability, and local demand vary widely. So does the type of return. Japan and Singapore may offer stability and low yields. The Philippines or Cambodia might be higher risk and higher reward. Avoid using the same strategy across countries. What works in Hong Kong may flop in India. 3. Underestimating bureaucracy and corruption. Some Asian markets have complex permit processes, weak enforcement of contracts, or issues with fraud. Title disputes, fake documents, or development delays aren't uncommon, especially in less developed countries. Avoid cutting corners or skipping due diligence. Work with a reputable lawyer, demand proper documentation, and verify property titles and seller credentials through official channels. 4. Getting sucked into hype. Just because a city is being called the next Singapore doesn't mean it's a good place to invest. Developers and marketers often overpromise, especially with off-plan properties. If you're shown glossy brochures and told returns are guaranteed, be skeptical. Avoid buying off-plan from unknown developers without checking their track record. Don't invest just because everyone else seems to be. 5. Ignoring currency and political risk. Your property might gain in local value, but lose you money in dollar terms if the currency drops. Some countries also impose capital controls or restrictions on sending money abroad. Others face political uncertainty or policy shifts that can affect property rights, taxes, or rent controls. Avoid holding all assets in high-risk currencies without a hedge. Check if and how you can repatriate funds or sell property later. 6. Overestimating rental demand. It's easy to believe rental income will cover your mortgage, but that depends on demand. In some cities, vacancy rates are high, especially in oversupplied condo markets or tourist-heavy areas that rely on short-term rentals. Avoid assuming if you build it, they will rent it. Study local demand, tenant profiles, and competition. Consider property management costs and vacancy periods in your math. 7. Failing to budget for all costs. Taxes, maintenance, insurance, management fees, and repairs add up. Some Asian countries also have hefty transaction costs or taxes on foreign buyers and sellers. Avoid looking only at the purchase price. Factor in ongoing and exit costs when calculating returns. 8. Using the wrong partners. Whether it's agents, lawyers, developers, or property managers, who you work with matters. In emerging markets, bad partners can mean lost money, stalled projects, or legal trouble. Avoid picking partners based on price alone. Do your homework. Ask for references, look for red flags, and prioritize transparency. Bottom line, real estate in Asia can be a great addition to your portfolio, but only if you approach it with clear eyes and a sharp plan. Avoid these common mistakes, and you'll have a much better shot at turning your investment into a long-term win.